Guys, we just have a quick question here from Cameron asking what exactly is a stock buyback? He often sees us posting buyback information inside the terminal and just wants more information on what it is and how to read it. So if we just quickly do a search, yeah, let's do it over the last 30 days. If we type in the word buyback, we should find a few examples of what Cameron is talking about. Let's see if we can find any. There's one. Nordea Bank receives ECB approval for up to 2 billion euros of share buybacks. Let's see if we can find something else. Here's one from Microsoft. Microsoft raises quarterly dividends by 11% and also announces up to 60 billion worth in share buyback. So in a nutshell, Cameron, what a stock buyback is when the company, in this example, Microsoft, when Microsoft uses excess money, excess capital, excess funds to buy back some of the company shares that's currently being held by shareholders. Now, from both a supply and demand as well as an EPS or earnings per share point of view, that is usually seen as a positive for share prices because when they buy back the shares, those shares go out of circulation and it's basically held by the company. So that increases demand as supply falls, which is obviously positive. And it also increases your earnings per share because there's less shares outstanding to basically do your EPS calculation with. So it's usually good for share prices with that in mind. But if the company is just buying back stock to increase EPS and the market knows that, then obviously the news of that happening can also be a negative for the stock price as well. But in a nutshell, think of it as just another way for companies to give back money or capital to the shareholders. There's basically two ways or basic ways that that companies can give back money to shareholders. The first one, the more commonly known one, is just by distributing dividends, by paying out dividends. And the other one is by doing stock buybacks, which basically just buys back some of the stock held by those shareholders. Now, there's a lot of issues that some have raised with stock buybacks. The Trump administration had some huge corporate tax cuts. I think they took corporate tax cuts down from, I think, 35 or high 30s to 20s to low 20s. And the tax cuts as well as buybacks got a lot of flack, a lot of criticism from people saying that the whole idea around the corporate tax cuts was for the companies to use that money that they save to basically do more capital expenditure, to invest more, to put more money into growth and R&D, to basically create more jobs. And the main criticism was that even though there was an initial pickup in capital expenditure by companies from that tax saving, it also saw a massive increase that you can see over here, a huge increase in stock buybacks as corporates basically use that excess money to buy back a lot of their stocks. So those that fight against buybacks, said it was immoral for those companies to do that because the shareholders got a ton of money, and the huge number of buybacks increased the earnings per share of the companies, which obviously increased the value of the stock options of the executives. Because when you buy stocks that was previously in the hands of shareholders, if you take that share out of the market, you increase your earnings per share. So they blame the executives that made the decisions to do all of the buybacks instead of creating new jobs by investing more into the company, by investing more into growth. Now, there's a lot of people that try to make this a political thing and try to make it a moral thing. I don't think it's really politically or a moral question. I think in most cases, those that criticize these types of actions have not been on the other side of the table before. For me, as someone who previously sat on an executive level of a company with shares before, these types of decisions isn't done without lots of deliberation. There's plenty of avenues that a company can use to spend extra money from a tax cut, for example. It's not as easy as just quickly buying new equipment and then voila, you have new jobs. And it's not as easy as investing money into new growth ideas and then voila, you can hire 100 more people or 1,000 more people. The real world and the real business, it's not that simple, right? So sometimes they might not be any real high return on investment projects that a company can invest to. Or maybe the return on investment in new machinery might not be attractive at that time. Maybe there's, like now, there's a huge supply chain disruption and things are just too expensive. And then a company can decide to rather buy back stock instead of investing in new machinery. So, um, or think about it this way: what if it's a company, like, think about energy companies who for years have been pulling at the short end, and the board decides to rather take the opportunity to buy back stocks, for those shareholders that wants to get a little bit of capital, after keeping their capital invested in the company for such a long time. Now, if that is the decision, then I can fully understand and accept it, because it's quite easy for those that are not shareholders, to criticize shareholders. But shareholders, at the end of the day, they hold all the risk, right? Especially if they're not part of the management team. If you are a shareholder and you're not part of the executive team or the management team, you basically put your capital to work, and you put faith in that management team to make sure that they make the right decisions and get that company profitable, so that you gain, so that the share price can go up, so that you gain value in your original investment. So, being in that position before myself, I don't find it a problem if shareholders are offered, to have their stocks bought back by the company, especially for those shareholders that do want to sell at that time. But where I do agree with the haters of this practice, so to speak, is where the buybacks just don't make sense, right? If you're buying back, if the buybacks are done to the detriment of the company or the shareholders or the employees, then it's obviously bad. For example, let's say that the company is in massive need of some capital expenditure. Let's say they need to fix equipment that's broken and too old, and it's hampering productivity. If the company then decides to do buybacks just to increase the value of their stock options, then obviously that's cringeworthy, right? That shouldn't happen. Or let's say that the company is currently overworking its staff to the point where some of your very talented employees are planning to leave. Then using excess cash to alleviate that stress by either sourcing new technology to help out with the workload, or by sourcing new staff, that would be the obvious thing to do. So if you then instead do buybacks and not help out your staff, just to increase your EPS, obviously that's going to be a bad thing. Or if they announce buybacks, but there are opportunities where the company could buy, let's say, smaller companies that's inside their supply chain to try and cut costs, and eventually, let's say in the next 3 or 5 years, potentially turn bigger profits, that would make sense. But if they then decide not to do that because they want a higher stock option value, because it's more favorable for the top executives that might be retiring in a year's time or 2 years' time, then obviously in that case, it's not even debatable that it's the wrong thing to do, right? It's going to be wrong in that type of environment. So whether it's a good or bad decision is mostly down to the situation itself, I think. For example, even though removing shares and increasing the value temporarily can, in the long run, be positive, it can, in the long run, also be negative, like we mentioned at the start of the video, because if the market knows that you should be spending money on maintaining your doing upkeep on your machinery, and you don't do that, then obviously that can be a negative as well. But this answer is obviously a little bit more than you asked for, but I thought it was important to discuss not only what it is and how it can potentially impact share prices, but also to understand some of the challenges surrounding the topic itself. That it's, some like it and some don't, but I think there's times when it's totally acceptable and when it should be more positive, and there's obviously going to be times when it's cringeworthy. But yeah, that's just in a nutshell what exactly it is, how it's normally expected to impact share prices, but obviously just with a few caveats in between as well.